I've had some questions regarding the material in Chapter 7, third-party rights, and I have that posting up on the screen. The quiz that is currently outstanding does have a few questions on this chapter, and the posting itself would provide the information necessary to answer those questions. I just want to say that because it's not as if I'm going to be adding new material in this recording. Instead, I want to just clarify some of the points that are made. And more specifically, what I would want to do is simply take some time and identify, by way of example, what is an assignment, and then identify, by way of example, what is a third-party beneficiary, and then, by way of example, what is an incidental beneficiary. What I would say at the outset is we're looking at two distinct concepts. Assignments and third-party beneficiaries have nothing to do with each other than the fact that in both concepts there is a party, could be a person, could be an entity, who was not part of the contract when the contract was made, but who then later acquires some status or rights under the contract. Let's start with the assignment. And I'm going to stick with the example I've put in the posting. Maybe I can just elaborate on it a little bit. So there came a point in time many years ago, that's most of my stories, where I wanted to buy a house. And I entered into a contract with the person who owned the house for me to buy the house. Now, what I needed to do at that point was borrow money in order to make the purchase. I needed a loan. And I ended up obtaining a loan from M&T Bank. And what we could say then is M&T Bank and myself entered into a contract. And the contract provided that M&T would loan me so much money, and over time I would pay it back so much interest. And in addition, M&T wanted security or collateral for the loan in the way it's done in a real estate transaction, which you'll learn in a real estate course, is M&T required me, as part of the contract, to give it a mortgage. And so we end up with M&T loaning Collins so much money to be paid out over so much time. I forgot how many years it was, at a certain rate of interest. And the contract also provided that M&T had a mortgage that I gave it, and if I didn't pay back the loan in a timely manner according to its terms, M&T Bank would have the ability to foreclose on the mortgage, which was its right then to use the house as security. I might add, in addition to the amount of the loan payment, and again you'll learn this in the real estate course, but M&T Bank, to preserve the integrity of its collateral, wanted to make certain that the homeowner's insurance that I was required to carry on the property under the loan, as well as the tax payments that I owed. This was in the city of Buffalo, so I would have owed tax to the county of Erie and the city of Buffalo, that those payments were made. And so much money then each month that I paid, in addition to the loan amount, was to fund a escrow account that M&T Bank then used to pay insurance and the taxes. Now, what happens is, and I remember this because it happened so soon into the loan, months into the loan period, I received notice from M&T Bank and from Chase Manhattan Mortgage Corporation. And the notices informed me that M&T Bank had assigned the contract, the loan contract it had with Collins. It had assigned the contract to Chase Manhattan Mortgage Corporation. So what then happens is Chase Manhattan takes the place of M&T Bank in the contract by virtue of the assignment. And by the way, in the vocabulary of the law, M&T Bank, by making the assignment, was known as the assignor, and Chase Manhattan Mortgage Corp was known as the assignee. A couple of questions could be asked at this point in time. Number one, why did M&T assign my loan to Chase Manhattan Mortgage Corporation? I can't give you a definite answer, but generally what I can tell you is that banks do this all the time. They bundle up mortgages and sell them to another bank, or sometimes just a loan type of receiver. And it's a matter of how money moves through the economy. What you have, and I mentioned this somewhere in the posting, is by me agreeing in the loan contract to pay back a certain amount of money at a certain rate of interest, the interest becomes juice. And certainly early on in the loan period, the interest is rather sizable, and M&T could sell the mortgage as part of its bundle and make money on the transaction if you take the interest into account, and Chase Manhattan Mortgage could sit on the loan and collect the interest and make more than what it paid for. It's kind of a form of currency. By the way, all of this works so long as the value of the collateral, the property, is at a appropriate market level. One of the things that happened in 2007 and 2008 is the U.S. almost went into a Great Depression, was that the banking industry and quite frankly the financial industry in general started loaning people money for properties that were overvalued, and oftentimes loaning money to people who really didn't have the ability to pay back the loan. And when those people stopped paying back the loan, and then one would look at the possibility of foreclosure, the discovery was made that the true market value of the property was a lot less than what the amount of the loan had been made for. It's a so-called property bubble. The other point I want to make, and obviously it didn't happen, I'm thinking this transaction was somewhere in the mid-1990s, and Buffalo, quite honestly, never became part of that trend of this property values here or whatever else we would want to say have always been pretty good in terms of what they call the loan to value ratio. The other point I want to make, was I worse off, or was I in any way placed in a worse position by M&T making the assignment to Chase? And the answer is no. I still owe the same amount of money with the same amount of interest, et cetera, except now each month and this is back before online payments, I had a little coupon book. Chase sent me their own coupon book, so I tear out a coupon, write a check to Chase Manhattan, put it in a pre-printed envelope, put a stamp on it, and that's what I was doing with M&T. And by the way, the contract, loan contract between M&T and myself did not have any provision that would have prevented M&T from making the assignment. When you look at the rules, if there was no provision preventing the assignment, and the assignment didn't make my performance any more difficult, then clearly M&T had the ability to do what it did legally. So that's at least one take on third-party rights in the form of assignment. Now I'm turning to third-party beneficiaries, and again, this concept is separate and distinct from assignments. What happens with a third-party beneficiary is that parties enter into a contract, and at least part of the purpose or the intent of the contract is to benefit a third party, meaning someone or entity who is not a party to the contract itself. The classic illustration would be a life insurance contract. So, for example, I enter into a contract with a life insurance company, and I pay a premium. There's an agreement as to the death benefit, and I name one or more beneficiaries for the policy. Because there was an intent to benefit the beneficiary or the beneficiaries, those persons or entities are known as third-party beneficiaries. The significance of that is those parties would have the right to enforce the contract even though they're not parties to the contract. So to stick with the life insurance aspect, I remember once representing a person who was a named beneficiary in a life insurance contract, and what had happened was the insured, one of the parties to the contract, had died suddenly, and the contract called for a double indemnity payment if the death was accidental, and there was a question whether the death was accidental or whether it was the result, sadly, of suicide. The period of the policy where suicides aren't covered had gone by, and the insurance company was willing to pay the face amount of the policy but not the double indemnity, which I might add was provided in the policy. My client had the ability to seek enforcement of the contract, even though she wasn't a party to it, because, again, of her status as a third-party beneficiary. And all I recall at that point is we brought a lawsuit and settled, so she ended up not getting the full double indemnity, but she got more than the face amount of the policy. If there's a third party who benefits from the performance of a contract, but there's no intent to benefit that party, and I have that laid out, let's say with a neighbor getting the house painted that badly needs painting, and if it's my neighbor, I may well benefit from my neighbor's contract to have the house painted because it'll conceivably raise the value of my house, but certainly there was no intent to benefit me, and thus I would only be an incidental beneficiary with no rights of enforcement.